In this video, we'll continue our discussion about executing an asset strategy. Um, we've gotten up to the point of talking about active versus passive management on page 26 of the notes. We've already talked about this some, and it is a big area of debate in the investment world. Active management is when you're trying to pick stocks or pick investment managers that you think will beat the market. So if the S&P 500 is up, say, 4.2%, to beat the market, you got to make more than 4.2% after fees. So your alpha, the term alpha is your return versus the market return, but it's net of fees. So if your fees are 1%, you would have to make 5.2% just to have an alpha of 0, because the market's up 4.2, you're up 5.2% minus your fees of 1%. You made exactly the market return, even though you beat the market before fees. Your customers did not beat the market after fees. So you have to really outperform the market by quite a bit if you're an active manager, because your fees will be higher because your costs are higher. What you're looking for are managers with really good processes, much more than performance, because performance can be really, really tricky. It's very inconsistent over time. I've done many projects looking at managers and trying to find managers that could consistently beat the market, and they simply do not exist. There's some who have long-term, very good histories, but even managers that have done well over 5, 10, 15 years, all of them have 1 or 2 or 3 years where they just really did badly versus the market. So it's very, very tough. So what's your alternative? Trying to beat the market is time-consuming, it's expensive, and you usually don't beat the market. In fact, I have right here a report from S&P, Standard & Poor's, on how managers have done, and you look at the 1-year period. This was, I think, a 2016 study. The 1-year history, 85% of large cap managers, 88% of mid cap managers, and 89% of small cap managers underperformed their benchmarks. Looking at 5 years, it's 92%, 88%, and 98% of managers underperformed their benchmarks. And over a 10-year, it's 85%, 92%, and 91%. Now, I've seen other studies that don't have quite as negative, but all of them show 60, 70% of managers at a minimum underperform their benchmarks. Now, Standard & Poor's, they have an incentive to show that managers underperform, because Standard & Poor's sells their benchmarks, the S&P 500, the S&P 400, the S&P 600. They sell their indices. That's how they make money. So passive management is a very lucrative business for them. So there's probably some bias in their numbers, but the bottom line is data consistently and overwhelmingly shows that passive management is a much more high probability strategy. You will win 85% of the time over the long run just by going passive, just because you're paying much lower fees, so you're starting off with a huge advantage. So what is passive management? What does it mean to buy the market? Well, you buy mutual funds that are indexed to the market, or commingled accounts, or exchange traded funds, ETFs, and there's many of them out there. Many of them are very, very expensive funds, charging almost nothing, especially when you adjust for things like securities lending that can add 5 or 10 basis points. Some of these managers, they may charge 5 or 6 basis points, but then they might make 5 or 6 basis points on securities lending, and essentially you're getting the market for free. So this gets us to the efficient market hypothesis. Hopefully you've seen that in another class. I'd recommend you do some Google searches on efficient market hypothesis. Fama is very famous for this. Nobel Prize winning lecturer who is the developer of this and back in the 70s. And there's 2 ways you can look at how efficient markets are. Why should you do passive investing? Because trying so hard to beat the market doesn't work, because markets price securities so well. And there's 2 ways to look at it. There's information efficiency and fundamental efficiency. Information efficiency says markets reflect all new information almost instantaneously. You just cannot be fast enough, because there are people out there that the second news hits hits the news services, or even before. Just amazingly excellent, fast access to information. Stock prices start reflecting that information. Bond prices, all prices start reflecting information. That's information efficiency. I do think there's a lot of truth to that. Fundamental efficiency is that all securities are correctly priced at all times according to the information available. There are no errors, there are no bubbles, there are no mispriced securities. Or if there are errors, they're uncorrelated, so people who are overestimating are offset by those who are underestimating. There's no systematic overvaluation or undervaluation in markets. I think that's the part people question the most, especially say in the 1999, the dot-com bubble. I think most people think that technology stocks at the time were systematically overvalued. People had their assumptions that just did not make sense. It was not efficient. But that's a big debate. Fama disagrees with that, and others. But how did Fama come up with his model? And he had 3 tests to see if markets were efficient. 3 tests of the efficient market hypothesis. The first group of tests were called the weak form tests. And here what Fama was looking at is, can you use past prices to get a superior way of picking stocks so that you beat the market? And his recommendation, or his findings, were past prices giving no information about future prices. You cannot beat the market by looking at past prices. Essentially what he's saying is technical analysis cannot beat the market. I recommend you look up the term technical analysis. There are many websites out there that provide technical analysis information. We use technical analysis in my job, and we did find it useful and insightful. What technical analysis is trying to show you is when demand and supply for stocks is out of balance, you will see that in stock price movements such that you can do trades that you can beat the market. There's a lot of debate on this. Fama says it doesn't work. There is a book by Dr. Andrew Lo. His last name is spelled L-O. You might buy that book. It's a book on technical analysis, and he makes the argument that actually there is some evidence that some technical analysis actually does work. If you listen to the famous hedge fund managers like Cliff Asness that talk a lot about price momentum is a technical analysis that stocks that are going up tend to continue going up. So there is a lot of debate whether or not Fama's findings were correct, but some of his analysis I thought was very, very interesting. One thing he did was create actual stock charts that the technical analysts were using. He used real live ones, but he also created some just using random generators. And the technical analysts could not tell a difference between an actual stock chart and one that was created by just random processes. So there's some indication that a lot of technical analysis is probably fictitious. Probably we're seeing things that aren't really there. But there's also a lot of analysis that shows that technical analysis may actually work. There is a book by Dahlquist, a former professor at UTSA, that is a very good book on technical analysis. If you're interested in that book, let me know and I'll send you a link to it. It's a good book. It's a little tedious past the first few chapters because technical analysis, there's just so many different ways of doing it. And so it gets a little tough. Her textbook, though, actually makes a strong argument for why technical analysis should be considered and why it is actually a viable, rational approach to investing. Very, very interesting book. So I recommend at least reading the first few chapters of that book. But that's the weak form, and that's where he argues against technical analysis. Then there's the semi-strong form. That's what he found, that if you using all public information, including past prices, he says that doesn't beat the market. Can analysts who use public information, can they beat the market? And he found that no, that is not possible. And that's a tough thing to beat because you don't know what all analysts are doing with public information. Maybe some of them do have superior models that they are beating the market consistently, but according to the analysis that Fama did, he says, no, using public information, you cannot beat the market. Now, hedge funds have discovered on earnings releases, for your paper too, you're doing an earnings release paper, that with earnings releases, hedge funds have discovered when firms release good information, the stock price goes up, but not enough. So if you buy stocks after a positive earnings report, over the next 3 or 4 months, you'll make superior returns. When firms report bad information and when they don't beat the expectations, stock prices fall, but not enough. And so if you buy stocks, if you short stocks in that case, you'll make money. That earnings announcement effect has seemed to have gone away because hedge funds have been exploiting it. But there is some information that there is at least some evidence that public information is not perfectly priced in securities and that there is some of that you can take advantage of. The problem with that is that hedge funds are looking for that all the time, and our ability to beat it, given how many PhDs in math are out there trying to find this information and execute on it, makes it really difficult for the rest of us. But if you find something that works, go with it, test it, and maybe no one else has discovered it yet. The last test was the strong form test, and that's Famas Test of all information, including non-public information. And obviously this is a very difficult thing to test. Do people with non-public information, with inside information, can they beat markets? And that's tough to beat. What Fama tried to do here was look at trades that insiders did, like CFOs and CEOs, when they made unusually large transactions of their own company stock. Did that provide a superior return? But very, very hard to test. There are rules, there are laws about using non-public information. If you're sitting on the plane and you're next to the CFO of a major corporation and you hear her say something about their firm that's inside information, if you go home and buy that stock based on that inside information, you are breaking the law and you can go to jail. So if you hear inside information ever in your job, the first thing you do is you call the lawyer in your firm and tell them, and that lawyer will probably call the firm where you got the inside information and tell them they need to release that to the public because it has gotten out. The SEC, anytime a firm releases information that causes a large swing in the stock price, they will go out and look for unusual trades. Someone who doesn't normally trade in options suddenly did a large number of option trades on this stock. They'll look and see what you've been doing. They'll say, oh, wow, you were on a plane sitting near the CFO of this company. They'll come calling and they may find you. The question here is the non-public information material or immaterial? If it's material, it is illegal to trade on it. But if it's immaterial, it is legal to trade on that information. So it is only illegal to trade on material, non-public information. And in fact, to just do an extreme case, if you were to discover 1 million pieces of immaterial, non-public information, if together it's material, all those millions of pieces of non-public information, if together they are material, you can legally trade on that information as long as each individual piece is immaterial. But if the non-public information is material and you do a trade on it, you can go to jail. You might have a big debate whether it's material or immaterial information, but that's up for a court to decide. So I would say don't trade on it, call your lawyer, play safe. It's not worth it to try to make a few $1,000s and then risk a few years in jail. How do you decide on a passive fund to buy? You look at its R squared. You want a really, really high R squared of your fund's returns versus the markets. You really should know the major indices before you start interviewing for jobs. For large, and this follows very much what we're doing on exam 1, U.S. large cap stocks, the main index there is the S&P 500. It is market weighted, and the advantage of market weight is there's very little trading. So if Apple is 5% of the S&P 500, and so you put 5% in Apple, and Apple shoots up a bunch, so now it's 6% of the S&P 500. You don't have to buy more Apple. You just automatically now have 6% in Apple. The original indexes were equal weighted, and that probably is a better way to go. As in fact, as a small investor, just by doing an equal weighted index, you can actually probably beat the market just by doing that. It works really, really well, but it's hard for really large firms with multi-hundred of millions of dollars in index funds. It's very difficult to keep equal weighting funds. There are some equal weighted exchange traded funds out there, and they may be interesting to look at, but they do have higher trading costs, so that's somewhat going to offset the advantages of indexing. The Dow Jones is an unusual index in that it's price weighted. So if a stock is a $100 stock and another stock is a $50 stock, then they're going to put twice as much in the $100 stock, which doesn't make any sense because that $100 stock could split and overnight become a $50 stock. And so the Dow Jones has to actually adjust for those stock splits over time. So it's a very unusual index. It doesn't have that many stocks in it. So it's not generally considered a good index for doing passive investing in. For U.S. small cap stocks, the Russell 2000 index is the most popular. Frank Russell is a firm, I think, up in Washington State that manages money but also creates indices. There's also the Russell 1000 index, which is a large cap index, but the Russell 2000 is probably the most famous small cap. S&P has the S&P 600, which is also a small cap index. For mid cap stocks, they're the stocks that have been doing the best the last 10 years. The S&P 400 is probably the most popular there. For developed market stocks, all those large developed countries other than the United States, the MSCI EFA is the most popular index. It unfortunately doesn't include Canada, but there are exchange traded funds that are MSCI EFA plus Canada that you can add that in. Canada is considered part of North America, so it's excluded out of the EFA. Then emerging markets indices, the MSCI, that's the Morgan Stanley Capital Index, although it's no longer part of Morgan Stanley. It's a separate company, my understanding. I think they spun it off. They have an emerging market index. For U.S. bonds, the Barclays Aggregate is a very popular index. That used to be the Lehman Aggregate, but now it's the Barclays. You have to be careful. These aggregate bond indexes can be heavily skewed toward treasuries and mortgage-backed securities. The last time I looked, they were 70% treasuries and mortgage-backed securities. So you got to be careful if you do the aggregate, whether it's the Barclays Aggregate or the Merrill Lynch Aggregate Index, you may be really buying something skewed toward treasuries and mortgage-backs. We already talked about equal weighted. Today, the hot new product are fundamental weighted indices. Robert Arnott is the champion for that. You might Google his name and read some of those articles. There's been some heavy debate between Robert Arnott and Cliff Asness about these type of new indices, and it's an interesting argument. You can go on YouTube and see some of those debates. But rather than weighting the stocks based on their market cap, based on their size, or doing equal weighted, they instead weight the stocks based on accounting measures like net income or net worth. The debate here is these are really not a new way of indexing. They're really value indices. Remember, we talked about value stocks and growth stocks. When you do fundamental weighted indexes, you end up with portfolios that tend to be tilted toward value away from growth. And value does tend to beat growth over time with lower risk. However, recently that hasn't been the case with growth stocks doing so well, but it is an approach. You might have heard the term smart beta, and with smart beta, that is one of those fundamental weighted indices. UTSA just created their first smart beta fund, so it's interesting. I've shown you before the methodologies for S&P and Moody's. They're in the notes. They're on Blackboard. They're on Blackboard, and they show you how S&P and Moody's break up their indices between U.S. and non-U.S. and large cap and small cap. Especially the MSCIs. It's a very lengthy document, but they go in quite a bit of detail about how they create these different indices. All right, so that's the first part of this class. We'll stop there, and we'll come back and talk through some of these other special issues.